A very warm welcome to the Creative Dealmaker Podcast. I'm Carl Allen, I'm your host, and I'm going to be interviewing expert guests sharing investor strategies that will completely and utterly disrupt the market when it comes to buying and selling businesses all over the world.
So a couple of questions for you on this, right? So first question is, like, you go out to like an issuance or a platform and they provide the infrastructure. It's like a fintech. You raise all the money, and let's say let's say you sell 10% of your ordinary shares, and you've now got 10% shareholders in the business. So let's say there's 1,000 of these shareholders, right? Because there's a low minimum. Clearly, they're not all now on your board. So does issuance act as like the board advisor, the shareholder that sits to check that everything's being done correctly? Or is there like no oversight from any of those investors at all?
Yeah, that's a great question.
Oh, yeah, that is a good question. So think of issuance as the fintech that's actually the compliance software for the transaction. So literally the same thing as Shopify, like in that capacity, right? But you need it to be able to receive the funds, transfer the funds, and sell the shares. Behind that, you've got your legal team, you've got your broker dealer. Now, the broker dealer doesn't act like a typical broker dealer. They do 1% across the board, and it's literally just a compliance element.
Yeah.
They're very light. They're just basically their compliance back in the backdrop. And then you've got your accounting team, and then you've got your transfer agent. So you've got a few different pieces going on behind the scenes. At the end of the day, they become your shareholders, and how you manage your shareholders is going to be the same thing as if you manage a public company. You're now going to have communications. They're shareholders though, right? So you're not looking at this. They're not getting on your board. They're not in controlling interest. They're not partners. This is like literally you got to think about these retail investors just like you would look at a retail investor in a public company. They need to be updated. They need to be updated. Material information needs to be disclosed the same way that you would run any private company. It's just that you have a few more of them. So you want to have a communications plan and for how you're going to handle your investor relations. Basically, that's what it is. And it's just managed.
That's so cool. So like in England, like if you go to like a Funding Circle or a Crowdcube or any of the UK guys, what they do is they'll go and raise all the money. So they got a big network of like investors that put the money in. And then what they do is they take a free piece of equity as well. I think they take 8% free equity of whatever's raised. So let's say let's say you're raising 20% equity, right? They'll take 8% of the equity as their fee. They'll sell the other 92% of the 20%, but then they sit on your board as a shareholder and then disseminate all the information down to all their.
Oh, interesting.
So it's really cool that
That's very interesting.
issuance doesn't do that. So here's my other question.
No.
Here's my other big question. So can you do this? So this issuance model of raising equity, can you do this on a business that you're about to acquire, right? So let's say you find an e-com company,
Mm-hmm.
and it's got a big following, right? And you want to buy that business. And let's say you wanted to do like there's a loan program in America called the SBA 7A loan program. So the way the SBA works, let's say you find a business and it's doing $1 million a year of EBITDA or cash flow, right? And let's say you agree to buy that business for $5 million, a 5 times multiple, right? Even though the deal that we're doing, we're paying 2.7 times EBITDA, and it's doing $6 million of EBITDA, right? But normally you'd pay a 5 times multiple on $1 million of cash flow. So $5 million deal. What the SBA will do is they'll say, right, the buyer's got to put $500,000 in of equity. The SBA will fund $4 million over 10 years in the high 8s, low 9s, and then there's a $500,000 seller note. So the buyer's got to find $500,000. Doesn't have to be the buyer's own money. It can be a family office. It could be a VC. It could be anybody.
They basically need a down payment that they need to flow through into the company.
Yeah. So it's a down payment. So can you use like an issuance type platform to go and raise the $500,000 of equity to form the buying group to buy a business? Or does this stuff only work if you actually own the company in the first place?
You've been dying to ask this question for ages.
I have, yeah.
On the like from what I understand, although there's lots of creativity happening in this sector as well, and which I don't, it's like a more of a conversation on how things are evolving, but you do need to own the business. It needs to be done through the issuer and the owner on the raise. So depending on, yeah, so you can't do it to fund loans is basically like, you can't do it in that capacity.
Yeah.
They are, one thing I just actually saw come through the mayor's office in Miami, and they forwarded it to me, was a group that is raising capital, almost like a fund that is financing businesses and then getting involved in the management. So, and that wasn't, you wouldn't see that a year or two ago,
No,
right? Like there's
no.
really lines in the sand, and we're starting, I think market conditions are obviously impacting access to capital. So
Yeah.
we're starting to see creativity in this industry, in this sector.